Hi everyone, welcome back to another episode of Invest Power series. It's been a while, but due to the lockdown and social distancing rules, unfortunately, I'm no longer able to do these videos from my office, and I had to resort back to doing my first one from my own home and my own room. So hopefully it'll still turn out to be okay. And obviously during this tough period, I'll continue to deliver content, deliver my investment philosophy, strategies to be able to help people across through this tough period, or what we think is an opportunistic period as well. Okay, so I hope you're all doing fine. It is a tough period. It is unprecedented. We haven't actually seen this much before. The scale of the damage to the economy, unfortunately, will be bigger than the 2008 GFC. But at the same time, if you're looking to capitalize on the opportunity, I would say this is probably once in a lifetime type of opportunity, because these type of events doesn't happen overnight and doesn't happen once in 100 years or something. So therefore, being an optimist myself, I've been watching the market like a hawk at the moment to see how much is going to drop, and whether there's any good opportunities that will trigger me to be able to jump into the market. Okay. Anyway, what I want to talk about today is really on focusing on cash flow rather than capital growth. And I'll basically get into a bit more detail. But personally, I think a lot of investors are always chasing the mythical capital growth. And I think it's a very important concept, because one thing that I don't like about capital growth is that you can't control capital growth. It's not something that within your own ability that you can flick a switch to go, right, I want capital growth to go up by 10% tomorrow or in the next 12 months. It's not something that you can do that easily. Whereas from cash flow perspective, it's something that you can control. And that's why I want to focus on these two different things and how you should be tweaking your mindset, especially in the current lending environment, how you can tweak your mindset to get you closer to that passive income goal of all of ours. So first point, I guess, is with the emergency rate cut that's been announced in March, and now we're seeing an official cash rate of down to 0.25%. We are seeing a historical low interest rate that no one has ever seen this before in the Australian history at all. So, that's why I think, given the low interest rate environment is going to be here, and look, we're currently in a pandemic as well, and it's going to be a big economy damage, unfortunately, and we're not even sure how long we're going to be out of lockdown period at this point in time. Fingers crossed that we should be out in a few months' time. But however, as Scott Morrison has pointed out, it could go on as 6 months. So just imagine how much damage it's going to be to the economy. And if that's the case, then we're not going to see the interest rate going up very, very quickly or in a short period of time, until at least the employment is coming back, and job growth and unemployment rate goes down. Job growth is steady. People are earning a modest income. They can afford to repay, and inflation is back on track again. So, I think RBA has made it very, very clear that the directive here is obviously not to raise rates in a short period of time, because they don't see that the economy is going to be in a good shape in a short period of time. Now, what does that mean for the investors? That simply means the interest rate is going to be staying here low for a lot longer. At least, I don't know, maybe in the next 2 to 3 years, that kind of stuff. And that presents a great opportunity for us to go into paying down some of the debt. So, I think debt reduction is important as getting more debt to a degree, because to be able to fully allow you to have passive income, you actually need to reduce debt. Okay. And what better time to be able to reduce debt than pay it down now, utilizing or capitalizing on the low rate environment that we currently have, which is never have been seen before. So that's why I personally think that this is probably a good opportunity to be able to, if you're in a position to be able to obviously pay down a bit of debt to actually lower your overall your real risk exposure position, or your total debt, essentially, is what I'm trying to say. And using this time to be able to get your finance in order. Because ultimately, you know, capital growth in a sense is not going to get you that freedom until you sell the property. Whereas cash flow, just imagine cash flow. If you got a property and you got, say, assuming it just for simplicity's sake, there's no debt tied to the property and you're getting rental income from it, that's what's going to support you. That's what's going to be the passive income stream, to be able to give you that freedom to choose not to work, to choose to do whatever that thing that you want to be able to do, to give you your time back. So put it simply, that's why debt reduction is as important to a degree in any investor strategy. You know, you need to have a plan about how you're going to pay it down. And, you know, that's what basically means, you know, if you have that cash flow, and you're able to control how much you can pay down, because let's put it this way, if you continue to pay the debt down to a level where the rental income is going to be sufficient to be able to cover all the outgoings, including the loan repayment, including you know, council rate, water rate, etc., all these things, if you're able to get it to that point where the property is breaking even, then that's a great start, because from that point onwards, assuming that you continue to pay P&I on that basis because the interest rate is so low that most of your rental income would be able to cover on the P&I repayment basis, then you've got a property that's actually able to continue to pay itself off over a period of time. And guess what? If you leave it like that for the next 5 to 10 years, it's going to continue snowballing like that, and the debt's going to continue to go down. Okay, so before you realize, you'll have an asset, and that's what the definition of asset is: an asset that's going to be able to feed you income. So not one that you got the debt, because at the moment, if you just acquire a property, you're not going to be able to enjoy the passive income from it, because you still got the debt. So in other words, you know, the rental income comes in and then it goes out, because it's going to have to cover all the loan repayment, all the council rate, all the water rate, all the PM fees, all that stuff. So by the end of it, when you initially acquire property, you're not going to be able to make it, you know, you might be lucky, a few bucks, yes, but guess what? There's maintenance. So you might actually need to pay for that maintenance as well, which means in the first few years, the property is going to be costing you to be able to hold them. And that's normal for residential property. But if you continue to pay the debt down, you know, focusing on reducing your overall risk of your portfolio, then at one point in time, you know, instead of having money to come out from your own pocket to feed the property and to hold the property, eventually it's going to break even. And breaking even at that point in time is a big milestone, because from that point onwards, assuming that you're able to make it self-sufficient, you know, then the debt will continue to drop even further. And that's how you can start getting some passive income. Now, capital growth on the other side, I'm not downplaying on capital growth as well. Yes, capital growth is important. However, what I personally think is that the last 10, 20 years that we've seen in Australia on the property market has been extravagant. It's so good. You know, we've had the prime years of our Australian real estate for the last 20 years. Now, we're printing a lot of money. QE has started. We're doing helicopter money. You know, government's getting themselves into trillions of debt, because the people needs that support line at the moment to get out of the economic damage that we're currently in. Now, what does that mean? They print more money, which means money keeps losing value to a degree. Okay, so in that sense, we are moving into a low inflation, low growth type of economy. Last 20 years, certainly wasn't the case. Government wasn't printing money. They weren't printing money even during QE. But now, it's something that we have not done before. We're trading in uncharted territory. They're printing money. But the way I look at it is, the last 20 years, in terms of what we're seeing, don't expect the next 20 years going to be the same. Okay, so therefore, I wouldn't bang on, say, taking the past 20 years historical data and then just use that as a projection to be able to say, right, the property is going to be booming again in 17 years time, you know, just like what it has done for Sydney and Melbourne for the last 7 to 10 years. Not necessarily the case. So that's why, you know, for me personally, I would say it's probably more, I want to play a bit of a more conservative approach. And that's why the landscape has changed. You know, I would no longer want to bang on the capital growth because, as I mentioned before, you cannot control capital growth. It's beyond your control. Yes, you can do to a certain extent manufacture equity and all that kind of stuff, but a lot of people when they basically want to get wealth out of it, they want to be able to capitalize on the market, and when the market really rises, that's when the tide rises all boats, right? But essentially, you don't control when that tide is going to come, and you don't know when that tide is going to come. You can prepare yourself for that tide to come, but you really have no idea when it's going to come. So that's why I suggest, if you want to have total control of your finances, then you need to be on top of some sort of debt reduction strategy, and having look at how you can maybe try to pay off and focus on paying off one of the investment properties or a non-deductible debt, like most people are doing at the moment. If they have a home, then they focus on paying that down. Fantastic, that's a great way. But ultimately, you also need to think about how you should be paying down some of the debt for your investment properties, so that until they're self-sufficient and they're able to pay themselves off, and from that point onward, it will snowball. Basically, the debt will continue to reduce even further. That's really the path that I think is going to take you to true passive income. Okay, so that's it for today, really. Hope I explained it well. If you got any questions, as always, comment below, ask me, email me at david@empower.com.au. Otherwise, guys, stay safe, and we're still in self-distancing, we're still in isolation period, so try not to make any unnecessary trips as you don't have to. Look after yourself, both physically and mentally, and I'm sure I'll speak to you again next week in another Invest Power episode.